So the ivory tower on Wall Street is changing Wall Street. The ivory tower changes Wall Street. So this is an article that I just put up on my website, and I wanted to talk to you a little bit about it because yesterday I was having a conversation with a client about, people are wondering about how the market works and why things are moving up and why things aren't moving down and things like that. So I wanted to just kind of set some of the records straight here because, there are three economists, and thanks to these three economists, we actually have a more reliable framework about how asset prices work and how investments move up and down. So for as long as there's been a stock market, investors have sought out, a reliable way to, look at stocks, look at bonds, look at future price direction. How are things going to go? And success has really been elusive because we've had a lot of false ways of looking at the markets. So thanks to these three economists that I'm going to talk about here, we have a better understanding compared to prior generations about how investments move up and down and why they move up and down. So the three economists I'm going to talk about are Eugene Fama, Lars Peter Hansen, and Robert Shiller. So all of these economists were awarded the Nobel Prize. So it's just really interesting to see how this works. And maybe you'll get some ideas about this because a lot of people are unhappy with their performance. Even though the market's gone up, they're unhappy with the performance over the longer term. So I think having this information, if you're armed with it, it can give you a lot of value. So let's talk about Eugene Fama first. Fama is considered the father of efficient market theory. Now, he postulated that markets are really, really good at incorporating all known information into the value of an asset, making it difficult to predict the short-term direction of a stock or bond. And we found that to be generally true. Fama is famous for describing market movements as nothing more than a random walk, and he discounts the efficacy of price prediction models. Basically, what this is saying is that you can come to the conclusion that many people would be better off just passively managing with index funds. So one Nobel Prize person has said this, and there's a lot of data on this, but there's an opposing side to this that actually shows other data that can be very, very helpful. And this is something that I think really can help people, especially when markets get very rocky. Another Nobel Prize winner, Robert Shiller. Shiller's work brought us a different, even a contradictory view. His research suggests that mispricing of assets occur because of human behavior, which can lead to excessively high or low prices relative to their true value. And his work is focused in on home prices, employment cost ratios, and he's got this Case-Shiller index that he talks about. And we have found this to be true. Some of the best investors in the marketplace talk about mispricing and how that's really, can give you an edge when you understand that we have these emotional biases. And there are tons of behavioral finance concepts, so much so that we now have a whole behavioral finance area and discipline that's taught in the universities. And people who are students of technical analysis have been keenly aware of this for a long, long time, for many, many decades. And now this is being incorporated into how we understand how markets work with the supply and demand and emotional elements and biases that we have. So now let's talk about Lars Peter Hansen. Hansen's research was built on Shiller's work, and he used statistical models to determine who drove or what drove market volatility. His work was a lot more esoteric, but he was well valued by a lot of economists. He concluded that mispricing that Shiller had talked about was connected to investors changing their risk appetite. So this is something that we've talked about, is that there's a time variance in your risk profile. And we see this in real time managing money for people. People will say right now, everybody wants to get aggressive. Well, yeah, they want to get aggressive now. Why? Because the market's already gone up. So we have this time variance of risk profiles. And the argument that Hansen says is that people become more risk averse during bad times and more aggressive during good times. This is 100% true. And this causes behavioral problems. Right now, we've been doing a lot of client reviews, and many clients are wanting to get more aggressive. They're literally asking the aggressive, should we get more aggressive? And when we were looking at our models, which are based more on evidence, they're actually saying to actually get a little more cautious. The market's down quite a bit today, but that's neither here nor there. But this is something that is really, really important. A level approach is better. So if you put these together, you get a good mosaic. You get this mosaic that a passive benchmark is going to be tough to beat when times are really, really good. And we found this to be true because it's fully invested. The highest momentum stocks that are working are going to have the highest percentage in the index, right? So you'll have more money in it. But whenever you have increases in volatility or choppiness in the markets, that's when a lot of people will start changing their behavior. And what we find with actual investors, and there's been lots of studies on this, is investors will actually do a lot worse than they would have had they had a disciplined approach. So if you're not happy with your long-term investments, maybe right now you feel okay, but we know, I've been managing money for over 2 decades, getting close to 3 decades now, lots of bull and bear markets. We know that a constant, consistent approach is better. When I say constant, I don't mean that means being, fixed weights in stocks and bonds. I'm talking about a constant way that you actually assess returns, correlations, and risk. So anyway, these 3 Nobel Prize winners, I've got this link. If you check out here, I have a link on the notes here. Go to that link, click on it, and check it out on my website. I've got some comments on there. And if you need anything, you can go to talktoluisllanes.com, and you can have a 15-minute conversation with me. I'll actually put this in the notes here, talktoluisllanes.com. And I'll just throw that in the chat. Give us a holler. Hope you're having a great one. We'll talk to you later.